So good morning, everybody. May I kindly ask you to mute your mics?
Donc, ce qui reste assez quand même, c'est que le mec, je vais prendre, quoi qu'il avait, quoi qu'il avait, et que je vais marcher avec dans le top. Donc, de toute façon.
Okay, so good morning, everybody. I hear that there is a lot of echo coming. Could you please close your microphones for this info session? We would like to welcome you. We want to present a bit of the ideas of this Quantum Grant Challenge, and for doing so, we invited colleagues from DG Connect and also from the European Investment Bank.
René,
yes.
I think we need to mute all these microphones first because it's
Yes.
almost impossible to. Just a second, let us see who really is doing this.
Ce que je peux vous dire, c'est que les administratifs qui sont au-dessus de la gestion de ces gens-là sont prêts à arrêter justement.
Okay, we started with a little bit of delay. I hope we can rectify this problem with an open mic. We dedicated 10 minutes of welcome and introduction from DG Connect, and then we transition with a little presentation on phase one that is given by EuroHPC, and then we will close the presentation phase by a presentation from our colleagues from the European Investment Bank, and then we open the floor to all of you for live Q&A. Yeah, is there a possibility to close the mics for all the participants?
Yes, so I'm trying to, I mute them all several times already, but it's there is something that I cannot see.
There should be a button, mute all.
Yes, I used it already several times, but seems not to be working.
Is it not at your end, René?
It is definitely not at my end, no.
Oh, okay.
Because then, Christian, I hope you feel comfortable. No, it seems to be so. Oh, no.
Yes. Okay. Wow, it's a piece for my ears. Very noisy before. Anyway, thank you very much, René, for the introduction. I have the pleasure to welcome you on this info session on the Quantum Grant Challenge, which is a new instrument that we have launched under the Quantum Flagship. Please mute yourself when you join for the benefit of the others. We are more than 100 participants, which I'm happy to acknowledge that there is interest, but for practical reasons, you need to mute yourself to respect also all the other participants. Next slide, please. So this is a joint effort between the European Commission that I do represent. So I'm Christian Tretzger from the DG Connect Unit C2, which is the unit managing quantum technologies. And as I was mentioning, a joint effort together with the EuroHPC joint undertaking that is managing phase one and the colleagues of the European Investment Bank. So you have three institutions joined together for this info session, which are the relevant ones. So first of all, just a very brief motivation. So why quantum technologies and why do they matter? We all know about that. The thing is that quantum technologies use quantum physics to build ultra powerful things like computing, communication, or sensing and measurement devices. Here today, for the sake of the Quantum Grant Challenge, I will concentrate only on quantum computing. And the idea is that quantum computing transforms many different sectors like medicine, energy, security, and many others, so that it has a prospective enormous impact on our society, and it has been, for this reason, identified by the European Commission as a critical technology. And in general, for critical technology, you want to maintain a certain strategic independence in this technology. Next slide, please. First of all, before going into the full discussion, I would like to give you one slide on what are European strengths and weaknesses in quantum technologies in general, but here in quantum computing. So I'm not going into all the strengths and all the weaknesses. We know that we are very strong in research, excellence, we have very nice initiatives like the flagship, etc. But what I would like to focus on is the strength that is highlighted here, which is we have a growing startup ecosystem and innovation potential. And by giving you some numbers, we have 25% of all the companies in the world are located in the European Union. And some of them are really jewels because they have technology, they are really good at the technological level and can compete at the international level on the technology aspects. But the weaknesses are also, I mean, I've put a few like fragmentation across the member states, but in terms of startups, the difficulties that we have is scaling from research to industry. And I would add even scaling industries. You certainly all know that now quantum computing companies are in the seek for hundreds or even 200 million euros of ticket, and this is very difficult to raise in the European Union. Next slide, please. So this is why we launched the quantum strategy with a vision to build on European strength and address the weaknesses. And the vision that we have is for the European Union to become the world's quantum industrial powerhouse and a market leader. So to lead the market and not to be a market in quantum technologies. And we have structured the Quantum Europe strategy around 5 strategic application areas. Research and innovation, we have to consolidate it. Quantum infrastructure, we have to support the production and design on the development. On the right-hand side, we see the dual use. We cannot deny the dual use of quantum technologies, and we would like to integrate these in the European space, security, and defense strategy. And skills, we all know that there is a lack of talent. All companies, all universities are telling us that there is a lack of talent because there is an increase in quantum technology activities. So we would like to develop the next workforce in quantum technology so that we have a good education, training, and talent mobility. And finally, the area in which I will concentrate today, which is the quantum ecosystem, where we are suggesting to invest in startups, scale-ups, and secure the necessary supply chain in the European Union for industrialization. Next slide. Let me introduce you what is the problem in this sector that we have observed. There is a market study published by the European Investment Bank that has been done together with DG Connect that shows that on the left-hand side, while the European Union is very competitive at the global level, because we have 25% of all the companies in the European Union, 25% of all the quantum companies globally, which we are at the same level with the US, for example. On the right-hand side, you see the issue. The worldwide distribution of quantum global funding is highly unbalanced because the European companies have been able to attract only 5% of this global funding. And this introduces issues of scaling up these companies. And one of the reasons that we have identified of why this is happening is a very European reason, and is because in the European Union, quantum projects are not bankable, in the sense that institutional investors like banks are not able to invest in these quantum companies. And we all know that European investors are traditionally more conservative and take less risk than the corresponding US investors. This was a general finding of, for example, the Draghi report. Next slide, please. And for this reason, we launched the Quantum Grand Challenge. But before going into the details, why bankability matters in this case? Well, I have at least 3 reasons why bankability is important. The first one is because it attracts private capital and reduces dependencies on subsidies. In general, bankable companies can secure financing to scale, which addresses exactly one of the issues that we have identified. The second reason is that it accelerates commercialization and global competitiveness. It is known that investors usually back firms with have clear business model in mind, enabling the EU to compete with other regions like the US and Asia. And the third reason is that bankability can strengthen strategic autonomy and technological sovereignty in quantum technologies, because financially sustainable companies tend to keep their quantum capabilities, IP, and activities in the European Union. And this is what we would like to have. And this is what we need to build a world-class quantum computing infrastructure in Europe with European technology. Next slide. And so we launched the Quantum Grand Challenge exactly to tackle this issue, this very European issue of bankability of of quantum projects, with the main goal to support European quantum startups and scale up in developing marketable quantum computing solution. This company need to demonstrate feasibility of integrated hardware and software quantum computing system, and we have structured the Grand Challenge in 2 phases. Phase 1 that will be implemented under the EuroHPC joint undertaking. It is a grant that will last approximately 4 months, and companies can get individually up to 400,000 euros. We will select approximately 12 companies to prepare a technical and financial roadmap. And during this phase, companies will benefit from the support from the EIB InvestEU advisory to prepare for phase 2. René, in a few minutes, will go into more details on this phase. Instead, on the right-hand side, you see phase 2, which is subsequent to phase 1. Where companies are expected to implement the technical and financial roadmap that have developed under phase 1 in 5 to 8 years with a convertible loan that can go up to 30 million euros. The idea is to select up to 6 companies for the bankable deployment, scalability, and real-world demonstration of the quantum computing solution. And after René, the colleagues of the European Investment Bank will thoroughly explain phase 2 in details. And next slide, please. And I think this is the end of my presentation. So I leave the floor to René for a detailed explanation of phase number 1. So thank you for your attention.
Thank you, Christian, and also good morning from my side. I'm René. I'm the program manager for quantum computing at EuroHPC joint undertaking. And as Christian rightly said, it is our mandate to implement phase 1 of the Quantum Grand Challenge. So I hope I can manage the slides. All right. So timeline-wise, this action has been published as of October, and we are foreseeing to close in January. The activity, and also, as Christian rightly said, supports the EU ambition to strengthen its position as a global leader in quantum computing and quantum technologies in general. And this activity is also tailored towards European quantum computing startups in particular, and it is structured in 2 phases, right? And in phase one, we are requesting each company to demonstrate a convincing quantum computing concept, including a clear financial roadmap. And at the bottom of the slide, you can also see how the timeline is expected to play out. Don't worry, you will get access to all of the slides at the end of this session. So the general conditions, we kindly invite you to check the call modalities if you haven't done so far on the Funding and Tenders portal. Don't worry, this is a hyperlink, so once you have access to the slides, you can navigate just by clicking on the hyperlinks. This is a coordination, or the phase one is implemented as a coordination and support action with 100% EU funding. I will say a little bit on that on the next slide. There is an expected contribution. Christian said up to 400,000. In the call text, we were anticipating it between 200 to 300,000, meaning that you can go below. You just have to motivate it. Just be careful. There is a modification to the general award criteria, and here we also advise to familiarize yourself really clearly with the documentation that is provided on funding and tenders and all the other on this info session and on the EuroHPC homepage. You have also submitted through funding and tenders. Many of you know the process already. If you don't, please familiarize yourself with this. There is an exceptional page limit, so it's 10 pages, but the 10 pages also just refers to the narrative text, right? The template that you will find, and this comes, you will see this in the next slide, already has more than 10 pages, but this is administrative stuff, right? So the proposal that you're writing, the technical proposal that you write, should have indicatively 10 pages. And then also please familiarize yourself with the general Horizon Europe program guide and specifically also with the Horizon Europe general annexes. So the expected outcome of phase one, as we said, it's a one-stage CSA. We expect here a detailed technical and financial roadmap. This will include performance milestones, risk assessment, financial viability assessment, and commercialization timelines. We also accept a form of a benchmarking strategy together with tangible proofs of principle or prototypes of full stack quantum computing platform. And please be aware that standalone software only or hardware only approaches are not eligible or will not be considered in scope of this activity. And this also applies to dedicated RNI activities, right? So this is not an RNI RIA action, it is a coordination support action. And then lastly, we also expect an application strategy to be submitted, identifying target sectors and also identifying industry relevant use cases. And then finally, you find all the templates that are necessary for you to prepare following the hyperlinks. As I said, it's a single stage CSA. We can understand that there is some confusion because if you have a multi-stage CSA, the template provided for Horizon Europe just has 10 pages. And this is where the confusion comes from, right? So just use the correct templates and then you're safe. You're safe to go. We also expect an ownership control declaration. Many of you are fully aware what that is. Just follow the link, familiarize yourself, fill in, encode the document and submit it with your proposal. Same is true for the ethics assessment. And then, if many of you have already relayed questions to us, we compiled a Q&A document. So you can find the Q&A document on the EuroHPC website. This is the one where you followed registering for this session. And there you can just download and familiarize yourself with this as well. We are planning to update this also on a weekly basis and then provide it on funding and tenders as well. If you have additional questions beyond the Q&A section today, please reach out to us at RNI EuroHPC joint undertaking europa.eu. And with this, I would like to close, and I would now like to give the floor to our colleagues from the European Investment Bank. I hope that you all have presentation rights. If you just let me know. Okay, Massimo, I'm just make you a presenter as well.
Hi, good morning. Can you hear me and see me? Just making sure first of technical. Okay, perfect. Okay, sure. Good morning. I will try to present now. Just bear with me for a second. You see my screen?
Yes.
Okay, good. So good morning, everyone. So my name is Máximo Almodóvar. I work at the European Investment Bank in the Venture Debt and Growth Financing team. It's a team of 30 people doing venture debt and growth capital investments all around Europe. I belong to the team doing deep tech and digital investments, and I'm quite focused on quantum computing. And the idea of my presentation is not only to speak about what our intervention will be as part of phase 2, but also taking the time to explain to you what we do from EIB in terms of providing capital and intervention solutions for startups, not only in quantum, but in other sectors, so that you have an overview of what we can offer. So I will start very briefly with an introduction of which products are available in general for startups, not only in quantum, but in other sectors. And basically, we have two ways of intervening into startups. So we have indirect approach or direct approach. So first, in the indirect approach, on your left, you can see our colleagues from the European Investment Fund. They have an indirect approach. They have the objective of dynamizing the ecosystem of VCs and private equity funds in Europe. And the intervention that we have here is that they provide capital to these funds to then provide capital to startups, not only in quantum sector, but in other sectors. So that's the first type of intervention that we have. Another type of intervention that we have that is indirect is, well, together with colleagues in the Commission, we are part of the European Innovation Council, where many of you probably know that you can also get access to equity and grants from the European Innovation Council. And in there we participate as well, and we have an indirect approach. But the purpose of today and the presentation will be to focus a bit of what from the European Investment Bank we do in terms of direct approach, so how we approach directly startups. And we have mainly 3 products. So there will be one product that is financial advisory, which my colleague Tobias will introduce a bit later, which is made to help startups to develop their value proposition, their applications, so that they can have a much stronger application for getting access to financing. Then the core product that we have, and it's the one that we will focus today, and it's the one that will be part of the phase 2, is the so-called venture debt growth capital financing. In here, we are talking about tickets that normally range from 10 million to 40 million, and they are in the shape of EIB venture debt, and I will explain a little bit later what it means. And then the third direct intervention product that we have is scale-up debt, which is a type of venture debt that is designed for companies that are way more advanced, way more mature, pre-IPO, already unicorn stage almost. So in here, what we are doing is tickets that are a bit higher, starting from 40 million to 120 million, and are more focused in accompanying these companies to reach IPO stage or exit stage. So this is an overview of the products that we have, and then we should dive into the product of venture debt growth capital, which is the product that we will have in the phase 2. Just a brief overview of the different stages of companies. Taking what we have explained before, basically in the first stages, until companies reach more or less commercialization, most of the approaches that we do and the intervention mechanisms that we have are indirect in intervention. So with EIF, with EIC, those are the types of interventions that we have for companies that have still to reach early commercialization. But once companies start showing commercialization and potential of growth, that's where our venture debt product starts kicking in. The type of companies that we are looking for are mainly innovation driven, so they have to have a very big component of innovation and disruption. They need to have raise at least a Series A plus of equity, because we need to see that there are private investors in the company, helping also helping the management team to develop the strategy, to steer the strategy, and to help them grow, not only with the capital that is initially in the companies, but also with some other investors putting some help into the management team. Of course, we will look for cases where we have a strong business model, a good governance, a good team, and that all the investments that we will be supporting are to be located in the EU. We will touch upon about that later, but you have to remember that we don't care that much about the corporate organization of the companies when looking at the EU aspects, but rather where the investments that we will support with our financing will take place. Those investments need to take place in Europe. So overall, this is how we position our product, and basically what is exactly venture debt and growth capital. Venture debt from EIB, what you have to think is that already in the market, if you research a bit and if you ask commercial banks, but also specialized players in debt, venture debt is a typical thing that commercial banks are offering for short term. Normally, we are talking about loans that are 2-3 years amortized with maybe 1 year of grace period where companies only pay interest rates. And they focus a lot on the interest component, on getting cash out of the companies, on the repayment of the principal, and not so much on the potential value growth of the company. So the potential of value growth is very minimal for these structures, and they prefer to focus on the short-term repayment capacity of companies. If you think about that, then on the other hand, we will have new equity raises where you have to raise more equity, where you have to dilute yourself. And in there, well, of course, investors are taking a higher risk and they are really betting on the valuation growth of the company. Our product basically sits in the middle, because what we are trying to do is to provide a way of debt, indeed, same as what the commercial venture players are doing, with the big difference that the capital that we provide, we don't normally ask for amortization. What we ask is, okay, the capital will stay, and we will ask for the repayment of the capital within 5-8 years from the moment that you made use for it. So you don't need to repay that until year 5 or 8, so we leave you capacity to grow. Then what we ask for in return in terms of remuneration, same as other players, we play with interest and we play also with the valuation growth potential. And the beauty of our product is that we can tailor-make the remuneration, so we can increase the interest if the interest of the company is, okay, well, I will have cash capacity, so I prefer to pay you interest because I will be able to repay, and I prefer to have less reliance on the value growth in terms of the EIB loan. But on the other way, we can do it the opposite way. We can say, okay, let's try to minimize the interests that the companies are going to pay, and then let's try to put a bet on the valuation growth. And for that, we have tools like, for example, Christian explained, a sort of convertible loan where we will try to get as much as the valuation growth. We will try to capture that the valuation growth as much as possible, and then reduce the amount of interest that we will charge to companies. So overall, in the end, it's a very tailor-made solution that is made for supporting the growth of companies. Normally, on average, we are doing tickets of between 15 to 20 million. I mean, we can do tickets that are slightly below for very breakthrough technologies or for certain geographies. But on average, we are working on tickets that are 15 to 20 million. As I said, this is a product that we offer all around Europe for all types of sectors. I mean, not only in quantum, but we have a long-standing trajectory of doing venture debt investments in the areas of space, robotics, semiconductors, AI, biotech, medtech, cleantech. So we have a very sound expertise in assessing companies and also in assessing what's the best tailor-made solution that not only responds to our needs, but also to your needs. So that's the beauty of this product, that is very customizable. And then I will drop to Desiree, to my colleague Desiree, to explain you a bit. I was explaining before that we will support investments with our financing. So I will leave my colleague Desiree to explain you a little bit what does this mean in practice and what's the EIB project. Desiree, I leave you the floor.
Good morning. My name is Desiree Rückert. I'm from the projects team of the European Investment Bank. So we are a bit special when it comes to banking because as you have seen Massimo, he's on the operational side, and I'm sitting in the projects team where we are engineers and economists looking at projects. So for example, if you are developing a quantum computer and you want to now get a loan from us, then we will define a project with you. So for example, you will say, I will develop a next version of my quantum computer. Then we can look at what kind of CapEx need there are, so which kind of new machineries you will have to implement in your laboratory. We can finance then as well the salaries of your R&D, and to a certain extent as well sales and marketing. And typically we look at a project that lasts for around cumulatively 3 years. And out of that, the EIB can finance up to 50% of it. What is important to note is that the EIB is not only looking at the financial viability of the product, but as well whether the project makes economically sense. So we will have the engineers checking the technical soundness of your projects, as well as the capacity of the management team. We will look at the market and demand. We will look at the economic profitability. So not only whether it makes financial sense, but whether there are positive externalities, so which very often is the case for very innovative products. And then, of course, we will check whether the project is in line with environmental standards or social standards. So you will see during due diligence, we will put quite a lot of effort into checking the project from all kind of angles. And we will as well stay with you then later on when it comes to the monitoring. So, but I think Massimo, you want to maybe do a bit of a deep dive how it typically goes, no?
Yeah, and then basically, we explain a bit about the product. We have explained about the project, which is important, but also same as the CIDE colleagues would assess the viability of the project, and they will look at the project. For us, our purpose is to look at the companies. So normally when we will assess the companies under the due diligence, we will be looking into the details. So we will look at the business and technology description that you have. What's your business model? What's your value proposition? What are the risks? What are your clients? So we will need to see that there's commercial traction and really the potential for growth. We will also, of course, look at the market, your competitors. How do you plan to have a competitive advantage that will stay over time? And we will also assess the management team, the people that you have, your investors, your financials. So we will have a really deep dive into the commercial part and into the financial part in order to make sure that not only the project is eligible and economically and technically viable, but also that commercially speaking, it's sound enough for investments and for an investment from the EIB. So we will execute a long due diligence, doing a lot of asking a lot of material from the companies and making sure that the company is really set up in the right way and in the right trajectory to capture that growth. So normally, I mean, and for the Quantum Grand Challenge, but also for other companies, I mean, we always have channels to reach out and send us the information. We have our Venture Debt email where you can reach out and ask and send us information, or you have also an application form online that you can fill. So you always have channels. And overall, that's a bit it from that side. I know there will be more questions. I also would like to ask my colleague Tobias to explain a bit. I will leave it here, Tobias, in the financing advisory. He's from the financial advisory, and he will explain to you a little bit what tools and what solutions are available for companies like you from the advisory team. Tobias, I stopped presenting, and I think you have slides, right?
Yeah, then I share my slides, yeah.
Okay, so I stop sharing, and the floor is yours.
Yes. Okay. See my slide? Yeah. Okay. So Exactly. So Maximo showed already where we are sitting. So I work in the advisory growth capital division, which is in the same department as Maximo, and we work closely together with our venture debt team. So in the advisory division, basically what we do, we have two kind of products. We have the ecosystem development activities and financial advisory services. Ecosystem development activities, these are all kind of more like say general things. So we do market studies. As Christian mentioned before, we have this Quantum Leap in Finance market study, which is on our website, which you can download for free. We also have a close LinkedIn group, which we usually regularly update with market news and market trends and information related to EIB and the European Commission is happening in quantum. We also regularly organize so-called finance labs, which are workshops or roundtables where we bring together the different EU institutions, so the European Commission, for example, and the EIF and the EIC and our venture debt team, to present a bit the products and also have an exchange with the quantum companies, the startups, the investors, and other key stakeholders. So here on the right side, a couple of quantum labs which we organize. We usually try to organize this alongside bigger conferences so that to reduce a bit the traveling for our participants. Then the more relevant part for the Grand Challenge, I think, is the financial advisory services that we offer. We have a certain selection criteria to select the companies for which we can offer these kind of services, which are generally in line with the selection criteria for our venture debt product. For very early stage companies, I would advise to contact the EIC, who also have advisory services. Our advisory services are basically what you can see on the right side. We are only five people basically in our division. So we work with external consultants to support us on these kind of advisory services. And it includes the review and update of the investor materials, of the business plan. We can develop a financial model. We can work on the scale-up strategy and the growth strategy, review the pitch deck, train companies to pitch. For selected cases, we can also offer an independent valuation. We have advice on bankability and financing options, and it's a kind of early assessment for the eligibility for potential venture debt transactions, which is also part of what we offer. This is it from my side. So I hand back to René.
Yes, so thank you very much, everybody, for contributing. And now we would like to transition to the live Q&A section. Some of you have already asked questions in the chat, which is a bit difficult for us to respond in live time, but please be bold, take the stage, take the floor, and ask all your questions live now. Yes, I can see David Niehaus.
Yes. Thank you all. I would like to actually come back to a question that was posed by Jonas Stein already in the chat. Us being a software company that is closely collaborating with a number of European hardware providers to whom we tailor our software, I would like to clarify whether we are eligible to participate in this challenge.
So if I understood you correctly, and please, I'm also giving the floor to my colleagues, to Christian and to everyone from the EIB. This call specifically, or say, let's say phase one targets the full stack providers, meaning that software only or hardware only is not eligible. And we implement it as a mono beneficiary grant with no foreseen subcontracting. So within these boundary conditions, it would be very difficult for a software provider to team up with a hardware provider.
Well, if there are contractual agreements in place that allow access to the hardware, I would disagree with that. But before focusing on a full stack provider, you're radically reducing the number of viable candidates that are allowed to apply, drastically reducing or drastically cutting away large parts of the quantum ecosystem, I would argue.
Christian, I think this is more a policy.
Yeah, no, well, this is what it is. These are the call conditions. I mean, I agree with you that practically you may have access to the hardware, but the legal constraints of the call are like this. So it's mono-beneficiary, as René was mentioning. So only hardware or only software is not possible. There must be, I mean, it's acceptable to start with a key component, okay, but there must be evidence presented or prototypes that showcase the potential and the feasibility for integration in the full system in phase 2.
Okay. Thanks for now. I may come back later with more questions.
Okay, then we have Alexandra Paul.
Yeah, thanks a lot to the Commission, the EuroHPC and the EIB team. So Alexandra from Pascal. I have 3 questions. So 2, I have put them in the chat. So first is René, if you could please clarify concretely what is the modification exactly we need to pay attention, unless there is something I didn't get. I know the criteria, but if there is something very specific, if you could please highlight it, this will be very much appreciated. The second one is for the EIB, rather on the side that you have mentioned, you have shown, you know, the different eligible costs, including RNI costs. So I would assume this would be related to stage 2, given stage 1 was clearly said that it's a CSA and not a RIA or IA action where R&D costs would not be eligible. However, I still have a doubt on that because as we already go, you know, to higher TRL and bankability already in the market, even if in stage 2, this would be eligible costs based on what you presented in your slide. There were no number on your slide, so I cannot tell you compared to the one from René. And third is a question really on the contents of the stage 1 and especially on the level of detail in the 10 pages that you are expecting in terms of benchmarking in particular and the strategy. Because as you know, nowadays there is not as such the existence of a real methodology to benchmark the different hardware platform, for instance, that you are asking there. We are advancing that, for instance, in some of the standardization committee to try to develop that methodology to be able to have something that is available for the different vendors or different platforms to be used, but is really work in progress and is not even yet available on the market. So I would also like to have a bit of clarity on the expectation there based on the reality of this type of activity today. Thanks a lot.
Okay, so the first part of your question addressing the different or the slight modification of the award criteria. So I put it in the chat that you have it as well. So it's still excellence, impact, and implementation as foreseen in for all Horizon Europe programs. But then we deviate with the sub criteria a bit because we had to tailor it to this action specifically. And you can see it now in the chat.
Yeah, but I don't really see which exact deviation you have made, unless you tell me it's on the 3, the roadmap development, for instance.
No,
but
if you read the sub criteria, so
yes,
it's excellent. Yes, and then they are not the standard Horizon Europe, so they're tweaked a little bit. If you can see, right? And then on the benchmark, we are expecting some preliminary, results addressing the different levels, so component level, system level, application level. It's a bit outlined in the call text, but we are aware about the maturity of the technology. And then in the end, it's a competitive process, right? So we have a panel to evaluate the proposals, and then if you can satisfy the external experts with what you provide, then this should be fine.
Okay, but on this, I just want to make sure that, you know, we request something that is realistic compared to the advancement of this activity of benchmarking to the markets. And so far, this is not yet, you know, developed. So that's what I want to make sure. So I understand the evaluator will look at that, but we need to also see the reality of this activity today is really happening, just to make that clear.
Okay, and then you had a question for the EIB. Colleagues.
Yes, maybe just to complement. So once we go on due diligence, right? So whoever will then be in phase 2, we will decide during due diligence what is going to be the project for the EIB. And there, obviously, RDI costs can be part of this project, which should be the case for a lot of the quantum companies that we see then. But not only, yeah, that's one of, I mean, CapEx is that there will be a lot of costs that are eligible for our project, but we do obviously take into consideration research costs.
Okay, thank you.
Then I have Chris Porthouse.
Hi, I'm Chris from AGIC. So I understand UK companies are not eligible for phase 2. My question is, if a UK company like us, headquartered in the UK, we actually have an entity in the EU. If we were to apply with a really clear plan to grow and conduct development for this project in the EU, would that still be considered?
I can take an answer to that. As explained during the presentation, for us, the geographical restrictions, there are two things. On one side, you have your corporate organization, which we will look at, and then we will look at the project specifics. If a company reaches certain minimum thresholds of project investments that are within the EU and are really supported and strongly clear that it's in the EU, theoretically, yes, a company that has a holding in the UK and then an operating subsidiary within the EU, if the investments will take place in the EU and those reach a minimum size, that company could qualify from the point of geography.
Okay, so you said theoretically, but realistically, do you think it's
it depends
fairly
on
unlikely?
The amounts. It depends on the amounts, because I mean, from experience, well, you really need to almost move a lot of investments outside of the UK and into the EU. So yeah, theoretically you could do it. Theoretically, you will have probably a lot, because I mean, for the activities that you all operate with, you need lots of cost. But it is something that needs to be discussed at the due diligence. But yeah, technically and theoretically, you could apply if the costs are in the EU. That's the limitation.
Because I believe we're eligible for phase 1 as a UK company, because that's a grant. Or would we, if we had not set that entity up, that's, the entity's there, but if we've not staffed it up and we don't have that clarity of plan when we apply at the phase 1 time, would we just simply be ruled out because we are not an EU company today? Or would we be considered for phase 1? Because I could imagine during phase 1 we would develop out those plans really clearly.
For phase 1, yeah. For phase 2, we will need to see the entity created. It's not that you can come with an investment plan for the future with the expectation that you will create an EU entity. For us, it would be important to see that you have already in the corporate organization at the moment of the diligence, the entity and some strong support that, okay, yeah, you are already executing and you already have plans. So from our side, we will have to look, as I said, two things. The corporate organization, that you already have an entity in the EU. And the second part is that the project investments are reasonable to be taken in the EU. That's for the phase 2. For phase 1, I leave colleagues to complement if need be.
So I might start and then Christian, please complement. So it's our understanding that UK entities are in fact eligible for phase 1, but the question necessarily then is, what is the reasonable outcome of a UK entity in phase 1 that cannot transition to phase 2? I mean, it's a 4-month CSA that prepares entities for bankability with EIB advisors. And if there is no realistic transition to phase 2, what is the point of being in phase 1?
Yeah. So I think we would develop that transitioning plan. We have the entity set up. We could grow that quite quickly if needed. Okay, I think that answers the question. I don't know.
Okay, next one is Thierry, please.
Good morning, everyone. Thank you at the European Commission, Euro HPC, and the EIB for taking time with us this morning. I put my question in the chat. I'll share it with you orally. Within our Quantum Industry Association, one point that was brought up is venture debt instrument already used in quantum has had negative impacts. First, for investors, the convertible conditions was unattractive to potential future investors, so it halted or rather slowed down the opportunity to find and attract new investors. As well, at the same time, for potential banks for additional loans, the fact that the EIB came first in all eventual repayments in the event of foreclosure or insolvency was also seen as detrimental, and therefore banks would shy away from adding additional loans. Question, therefore, is in the context of this Quantum Grant Challenge, is the EIB able to make adaptations to the terms that address both of these points, towards investors on one side and towards other banks on the other side?
Okay, thank you very much, Thierry, for your questions. And yeah, these are points that we have heard. I mean, normally we know that we remain within competitive terms. I mean, in the industry, I must say that we don't have a lot of deployment, but we have a lot of deployment in different industries and different EU countries. And well, you have explained some of the concerns, but there might always be concerns from some companies, from some others, no. I mean, we will look at each case individually because, as mentioned, I mean, this is a tailor-made solution, and it's not the same for a company that is at very early stage, the type of financing and the type of structures that we need to implement compared to a company that is well more advanced. So we will try to be a tailor-made solution, not only for the sector, but also for the company. So from our side, we will make our best efforts to provide something that works not only for us, but also for the companies. So I take note of your concerns and your comments. It's much appreciated that you share this feedback with us, but we will have to see for each company what's the best solution there. But always, one point that we reiterate to companies whenever we talk is like, it's never in the EIB's role, the position of generating problems to companies. We are there to help companies to spur growth, to attract other investors, and we try to be as helpful as possible. We are not there to generate profits. It's not that we are a for-profit institution. We are there to support growth. So whenever there are situations like this, our position is to be as helpful as possible. But yeah, again, it's on a case-by-case basis. We will have to see. But point taken, and thank you for sharing the feedback, Thierry.
The next one is Siebe van Mensvoort.
Yes, good morning. Thank you very much for your presentations. I am the CEO of a quantum startup at a very early stage. It's called Picard Systems. And my question is, what is the earliest stage a quantum company can be in to be eligible or to make a chance, let's say, to enter in the current call? And what would you be looking at for such a company in terms of what it has to prove to you to become granted, to get granted?
Christian, would you like to start?
Do you want me to start? Yes. And then René, maybe you can complement, and maybe Maximo, you can add some additional element. I think there is no really particular point for the grant for phase number 1. Okay, you just have to fit as best as possible all the criteria that René has shared for excellence, impact, and implementation. In particular, then what you have to produce is a technical roadmap and a financial roadmap that these aspects then will be and particularly the let's say the financial aspects will be assessed by the EIB. And here I leave it to Maximo that I clearly identified the product of the venture debt within some certain boundaries. So not an expert in that, but if I remember correctly, was starting from Series A or something like that. So I would prefer that Maximo confirms where you need to be in 4 or 5 months, including the due diligence after phase number 1. So there are no particular, let's say, demands on phase to enter phase 1, but yes, to enter phase 2.
Yeah. Thanks, Christian. Yeah, happy to complement and yeah, glad to hear this question. And when you receive the slides, you could revisit this. But yeah, as mentioned, from our side, what we would like to see is companies that have a proof of commercial traction or at least a proof that the growth is coming. So they will need to have certain capital support. They need to have a capital that is healthy enough to support that growth and to support and digest the product that we will give. And we will also need to see a company that is very well structured in terms of governance, in terms of team, and in terms of the strategy. So we need to see relatively a higher degree of maturity than just a company that is starting to develop a prototype or a technology. We need certain maturity. Which level of maturity, of course, it will depend on the companies that we will see, but we will have certain minimums that were explained before in terms of, okay, how much capital has been raised, what's the capital position of the company, what's the team, the governance, the financial structure, etc. But I'm sure once you receive the slides, you will have more clarity on this, but I hope this is clear enough.
Thank you.
Okay, then the next one is Victoria.
Thank you also from my side for your time and for the presentation. I'd like to go back maybe also to David's question a bit about the target group of the call. I understood now clearly that the target group is only a full stack company, but could you please elaborate a bit on the background on the why of this decision? Do you know the background a bit? As indicated, this cuts out a lot of potential companies in the supply chain. And do you really expect that only one company is able to reach all the KPIs that the European Commission is requesting in the call? Just to get a bit an understanding of the decision, that would be great.
René, do you want me to say something on that? Yes. So the structure, well, and maybe I can combine several elements that I see around this because there are some questions around this, so that maybe I have the opportunity to answer multiple points. So the point that you're putting forward about the number of companies. So the expectation is that to be able to support during phase 1 about a pool of about 12 companies, okay, for the implementation during phase 1. And from that pool of companies, we are expecting to select 5-6 companies to enter into phase 2. So roughly 50% of success from phase 1 to phase 2. That is the idea, because this is, let's say, a sufficient pool to guarantee that we have a certain, let's say, good selection of the companies, both at the level of phase 1 and at the level of phase 2. There is a question of budget, because the money that is, so I see people are making calculation. This is very good because it's already a starting point on the financing perspective. The budget that we provide as a European Commission is actually more than 100 million euros of EU guarantee, is 130 million euros. And the construction is made in such a way that this package comes from the European Union, and it will be doubled essentially. And the doubling of it comes 60% from InvestEU and 40%, if I'm not mistaken, from European Investment Bank. bank, but I prefer Maximo to or somebody from the EIB to confirm this number. So it will be doubled. So we will have a package of, at least for quantum, well, about 260. And yes, the idea is not to share, divide them exactly with the number of companies. It depends on how much each company is requesting. It's really tailor-made, as Maximo was explaining. Each company has a different business model and different needs. So it can go, the ticket for an individual company can go up to 30 million euros. This is, let's say, the boundary and the exact number. And then maybe before giving the floor to Maximo to confirm these numbers, there is a question on comparison with the QBI in the US, because it's phased in phase 1 and phase 2, etc. Here, what I would like to make clear is the fact that, yes, we have 2 phases, like, let's say, the QBI, but the approach is different. The QBI, they do it at the technical level. We, in our grand challenge, of course, we are based on a technical thing, of course, because it's quantum computing. So in this sense, it's similar. But the approach and the leitmotif, so the guiding line of the European Union Grand Challenge is the bankability, which is a typical European problem. It's very difficult in Europe to raise 100 or 200 million euros. It's not so difficult in the US. Companies get 500, even 1 billion. And there is a highly imbalance, and we have to address this exact point. So in our case, is addressing exactly this typical European problem.
Here, my question was more tailored towards why only full stack and why not more parts of the supply chain. I understand the objective, that you want to fill the scaling financing gap, but this is not only for full stack companies a problem, but for more companies within the supply chain. So okay. I wanted to understand this decision for only full stack and not being able to collaborate within the ecosystem, because several companies might also have different focus areas.
Understood. Yeah. Yes, I think it's a very good question. Thanks for it. And the short answer is because we are doing things. So if we want to address bankability, you need a bank to help you. And what best of having the European Investment Bank, which is a AAA institution, to help us in helping companies to become bankable. And the thing is that, so if we do things together, we need to find good business cases. And actually, the bank knows quite well that full stack quantum computing at this stage is a good business case. So we can have a pipeline of companies to select that can absorb this kind of financing, and the instrument can be successful. If we see in the future that the instrument is successful, it fits well, and there are other technological niches, that can fit in such an approach, we are open to it. Because, as you know, the bankability issue is not limited to quantum computing. It's everywhere in quantum technology. So we would like to address that issue. And if it works for full stack quantum computing, then we can apply it to other sector. In fact, we are preparing it a grand challenge in quantum sensing that is in the work program 2026 of Horizon Europe that will come out next year, and this will address quantum sensing. But again, we are open to apply to other, let's say, technology sectors.
Thank you.
Then I have Jochen Wolf.
Hello. I have 2 questions. So my first question is around the financial terms. So I understand that for the convertible loan, the terms are probably unique to each company. But what are like typical terms on the financial side? So interest rate and so on for this, and what is a typical loan duration for this?
Okay. Hi, Jochen. Thank you very much for the question. I mean, as mentioned, I mean, it's very difficult to describe terms because, I mean, we really have a customized solution for each company. We can say that the terms are quite competitive. In terms of convertibles, we have structures that are similar to the typical standard convertibles that you will see in the market, but with a much more longer time span. So we can have maturities that are not short, but that rather like 5, 6, 7 years. So that's longer than what you see in the market. When focusing on the average product, that again, I'm quoting it as an average, not necessarily the one that the companies will get, because it will be customized to companies. Normally, we have an interest component and a warrant component, and in the interest component, it varies a lot because the type of interest rate can go from a regular interest rate that can be paid cash on a regular basis. It can be an interest that is deferred or PIK, so that you don't pay anything up to maturity. So the range varies a lot, but normally for a long-term financing where you have principal not being repaid within 6 or 7 years, normally our interest rates are quite competitive. I mean, I cannot tell you, I could give you a very broad range. We have seen from 4 point something till 9, but it very much depends on how we structure the transaction and also how much weight we put on the equity remuneration side. So on the actual bet on the valuation growth. On the valuation growth, it is also depending on the jurisdiction. It is also depending on the company, how that is structured. Typically, we structure the remuneration, the valuation, or the so-called equity kickers. So how we get the economic benefit of the equity growth, the equity valuation growth of companies. That could range from warrants to option rights to synthetic warrants. But on average, we really have a very, very minor dilution effect there. And it depends very much on what the company needs, but it's normally a very minor dilution effect, and it compensates for such a long-term capital provision that we are giving to companies. But it's difficult for me to tell you a specific range because each company will have its own characteristics. But what I can give you, if you are familiar with venture debt in commercial players, and normally a venture debt in commercial players, the equity kicker is defined as a percentage of the nominal of the loan. Typically, they ask for a 10%, but then the interest rates are most of the times double digits. And remember, 3 years. Normally for us, our interest rates are single digits, but for 8 years or 7 years. And then the equity remuneration, we can take up to maybe 20, 25%. So we might take a little bit more equity risk, but also we are taking a much more long-term risk on companies, and we limit a lot the cash flow going out. So that's what I can tell you about terms, because as I said, it's a very customized solution.
Okay, thank you. And another question was, what are typical phase 2 milestones that are foreseen to be defined? And again, that's a case-by-case basis, but what are typical foreseen milestones?
Well, in the presentation, I saw some of them. I mean, first of all, we would need to see that you have raised equity, and ideally you should have at least a Series A. I mean, it's true that if the company is very capital efficient, which in the industry and in the sector, in my experience, is difficult to find. But normally we would like to see that the companies are capitalized and that you have already at least one private investor that is helping you with defining your strategy, defining your roadmap, and also trying to define, okay, what's going to be the exit in 7, 8, 9 years from now of the company. So definitely looking at the cap table and seeing that there's an equity raise is an absolute milestone for us. And then I would say that the other milestones would be the typical ones when you are assessing bankability and commercial growth. So we would need to see that there's a proper management team, that the company has a team that is fully fledged, that it has not only the capital resources, but also the human resources necessary to execute the project, the product, and the roadmap, and also that the project cost, as we were mentioning, it reaches the threshold of the minimum ticket size that we will be talking to, which would be like around 15 million. Normally, we would expect tickets ranging from 15 to 20 million. So you really need to prove that your project, which we explained before, needs to be double that size. So that's also why we ask you, okay, you will need to be capitalized, but you will also need to have the appropriate human resources in order to implement that, because a plan of 30 or 40 million in investments within 3 years, it's something that requires certain degree of maturity from the companies to be able to access our financing. So overall, I mean, again, I think it's commercialization stage. Ideally, you should prove commercialization, you should prove growth, and you should prove that you have capital and human resources. Those 4 areas, I think, are the ones that we could highlight as conditions or milestones.
Thank you very much.
Okay, the next one, and please forgive me for butchering your name, is Ion.
Yes,
Scanlon.
Owen.
Sorry.
You. Yeah, and thank you to everybody from the EIB, Euro HPC, and the Commission for taking such a lengthy Q&A. My question is somewhat related, but specifically, the venture debt mechanism covers up to and including scale-up companies, at least according to one of the slides. What happens, over the duration of particularly the phase 2 of the project? What happens if through other means a company becomes a publicly traded company, for example, or something changes in the company's on the company's front that way? Does the project continue? How does that change the dynamic?
Yeah, I can take that, Owen. So thanks for the question. I mean, if I understood correctly, you want to understand whether if within a phase 2, if I understood the question is, let's imagine that in phase 2, we receive a company that qualifies, and then during the process of the phase 2, you have been granted with that solution, the company becomes a scale-up, right? If that's what I understood, if that's the case,
no, specifically, I mean, if the company moves, sorry to cut across, if the company moves from a scale-up to being, for example, a publicly traded company.
Okay, an exit or that. I mean, in principle, because I mean, it's normally, I mean, the companies that we will see in here, I don't think they will be scale-ups when they access to phase 2. We would be surprised, but happy to have any. But the product that we will offer will be the standard one, not the one for scale-ups, that to begin with. So to clarify, the product that we will offer here will be the standard one. And if during the process of having that phase 2 financing, if there's I mean, what you're describing is an exit event. I mean, technically, if the company goes public, it means that suddenly it starts becoming more accessible for the capital markets. So our intention, as I mentioned before, is not to basically look for a profit. So the intention of the EIB when there's an exit opportunity and when we are perceiving that our capital is not needed because the company will find it somewhere else, I mean, we will be open to exit and then let the company grow organically without our help. It would be a great case for us, of course, because that would mean that we have put the capital in practice and help the company to actually exit and get access to the capital markets. But in principle, that's what would happen, that we would have basically completed our role there. And what we could do is then that company could actually apply for our own products for the scale-up product, let's say. So imagining that then become a competitive player in the market and they become a scale-up, the range of products that I have shown to you for the EIB are available for all the other companies. So no necessary that you are in phase 2, you will be accessing that one. You can apply like any other. So technically, you could apply for getting a scale-up debt for the next stage. So I don't know if that covers your doubts, Owen.
Yes, that does answer my question. Thank you.
Okay, perfect. Thanks.
All right, so I have Anne-Marie.
Yes, thank you so much for taking so much time indeed, as Owen said. My question says a little bit back to what Alexandra said before. I'm still a little bit confused on what should be in the 10-page proposal, as it is actually a proposal to write a proposal, right? So should we already contain plans for phase 2, or should it really be more about the company? I was wondering if you have a little bit more insight on that.
So I will start, and then Christian, please complement. So in principle, you should always start with addressing the award criteria and also the expected outcome and scope of the call text. And then to what extent you should also outline your phase 2 activities. This I would really like to include Christian in the discussion.
Yes, no, as René was mentioning, you have to cover the all the criteria and sub-criteria well, because it's this that gives you the entry point to phase 1. You will be evaluated to these things. Phase 2, when you go to phase 2, you will be evaluated. I mean, Maximo can clarify about the process, but you will have at least 2 steps. The financial pre-screening that can be yes or no, and the full due diligence that can be a yes or no, which are different, let's say, different steps, and they take into account different things than what you have in the proposal. This being said, the financial roadmap and technical roadmap, I expect that you submit, that you develop something that is over the mid to long term, or well, I mean, not only for a duration of the grant, so it will extend also to phase 2. I mean, you are constructing a roadmap that that is for the company. So this has also implication for the phase number 2, and then this roadmap can be used and how to say considered during the process that the EIB that I was mentioning, pre-screening and due diligence. But for sure, it will not be limited to that. I think it's quite a process that sees many other things, as this morning was shared together with you. But it has, I mean. There are some elements of phase 1 that will be also overlapping with the phase number 2, notably the roadmaps.
Thank you. If I may follow on that a little bit, it was completely clear actually this morning what you all said. My point was more that I kind of expect that you also want to see a roadmap already in the proposal for phase 1. So basically, a proposal we're handing in right now. But this roadmap should also be developed in phase 1. So that confused me a little bit, right? That probably a couple of things that you would like to see in order to assess companies is something that is also asked to be developed in phase 1. So what basically should we include already in the proposal right now, and what should we leave in order to be developed further in phase 1? I think that's rather the question.
Well, this is again, I will go back to really to the practical outcomes. You have to address all the elements that are in the criterion and sub-criterion, because you will be evaluated in that one. With respect to the roadmaps that you can submit, this is really up to you. Take into account that you will benefit from advisory of EIB InvestEU advisory for this kind of element. So for sure, you can submit if you think a perfect roadmap. That's a possibility. You can submit from starting one from entry point of phase 1 a roadmap or some vision of a roadmap that you want to develop, and then you can get some assistance from the InvestEU advisory. But maybe here, Tobias, you can maybe explain a bit the role of InvestEU advisory and in developing better, for example, this financial roadmap.
It's okay. Let's continue to the next question. Thank you so much.
Tobias, yeah.
I mean, yeah. So the advisory is basically for companies that are on the basically having good possibility of qualifying for our venture debt product. And then for these companies, we can then basically work together on the financial roadmap. But this is then a close collaboration with the company and with our kind of third-party help. And then we look at all the different documents that would be necessary for a good assessment for our venture debt product. Does this answer your question? Or?
Sure, thank you.
Okay, so the next one is David.
David Chow, Global Quantum Intelligence. Congratulations on the launch of what I think is going to be a really influential initiative across the sector. I appreciate Christian already dealt with the high-level comparison between DARPA QBI and the Quantum Grand Challenge. Wanted just to drill into one aspect of that a little bit more. Obviously, one of the things that the DARPA QBI people say about what they did in Stage A with a deep dive technical evaluation by an independent party on the technical aspects, and they would present that as providing reassurance to investors and potential investors. Now, I think what I'm understanding is that activity per se is being moved into the diligence part of the entry to Stage 2 of the Quantum Grand Challenge. But one of the things in the DARPA QBI process is they had a parallel exercise to request proposals from the independent parties that would provide the deep dive expertise to provide the independent assessments. I don't know whether that's something you're communicating yet or whether you already have established plans on how that type of expertise will be provided to assist the process.
You mean expertise in our case?
Yeah, so DARPA QBI, they had a call for proposals from the independent parties to provide the evaluation services. And it was often national labs and institutes around the US that applied for that. But it was a process that put that in place to provide the for the Quantum Grand Challenge.
David, I lost a bit the connection with you, but if I understand correctly, you're asking about what is an analysis at the technical level in our, let's say, Grand Challenge, in this Grand Challenge at the technical level. Okay, so then maybe this is for the EIB, because I understand that there are two aspects. One is the pre-financial screening, which can be a yes or no. And the second aspect is the full due diligence that, as it was explained this morning, is a thorough process that looks at the company at different angles, including at the technical one. So then for these details, I maybe Maximo, if you can maybe say a few words about.
I will try to see if what I can provide answers David's concerns. For the EIB, and not only in the Quantum Grand Challenge, but in all our activities, so for any other sectors, when we are approached by companies during the due diligence, we do our own technical evaluation of the projects and the investments that we're going to support. But there are cases also in that, well, if the companies bring some additional technical reports that they got from external advisors, we are happy to look into those and make them part of our DD, and also as part of our internal technical evaluation of the project, we will consider those documents as a reference point. But normally we will conduct always our own DD, both technically, economically, financially, and commercially. But we are always welcome to see if there has been some work being done before. But I hope that clarifies our other question, David.
Yeah, thanks very much.
For phase two would be the same. So same as we do with all other companies, in phase two we will have the same situation. So if during phase one you have developed, I don't know, a technical assessment from an external advisor, then at phase 2, would be very happy to see that we receive that report and it will be part of our due diligence, but still we will conduct our own assessment of your technical capabilities.
Okay, fantastic. So Eva, you are next.
Okay, thank you very much. The European Commission, the Euro HPC and EIB for this session. My question is regards that the expected outcomes of phase 1 includes the technical roadmap, the financial roadmap, the benchmarks, the prototypes, application strategy, and those letters of intent. And in the objective, it is said that the company should showcase added value for one or more carefully chosen application sectors, and that will be selected based on technical feasibility and projected market return. So my question is whether whether the due diligence performed by the EIB is based only on those carefully chosen application sectors, and the proposal should be only focusing on one or more, and what is maximum number of application sectors, and whether those benchmarks should be tailored to each of those specific application sectors chosen, or the due diligence would be more on the general business case of the company. Thank you.
I can take what I understand is through EIB, but at the phase 2 stage, we will do a general due diligence of the companies. We will, of course, receive the materials and we will see what has been presented during phase 1. So yeah, you might focus on one or two cases, but when we conduct our own due diligence, we can also receive other business cases. Also, I mean, given the timelines and given the speed that the market moves, it might be the case that you are focusing now. In 6 months, actually, there's a better case study that you should focus on or that you should include. So at least for the phase 2, when doing the due diligence, we will be open to see more business cases, more case studies for the application of the technology. But of course, we will already see what has been proposed initially. So if you propose a base case or a case study that you were applying and suddenly you drop it because you decide that you need to go somewhere else, we will ask questions during due diligence. But we will be open and we will look at more general applications and not so focused on a specific business cases as for the phase 1. For the phase 1, I don't know. I leave colleagues to complement, but that's from the EIB how we will look into it.
And for phase 1, the situation is rather clear because it's a competitive process, meaning that you have to convince the panel of experts. And whatever you provide, thinking that we'll do so is the best way forward.
Yeah, but my question is, both technical and financial roadmaps should be presented for each of the application chosen? Each of the application.
I mean, Christian said it already a bit. So you prepare something, you prepare a financial and technical roadmap to enter phase 1, but the focus is very clearly on the award criteria, on the expected outcomes, and so on. And then within phase 1, you have the liaison with the EIB advisors to develop these roadmaps in order to bring you towards bankability, right? So the entry conditions for phase 1 are not so strict on these roadmaps.
Okay.
Yeah,
my question was more targeted to the application sectors, whether
I
should
understand.
bet for energy or finance or wherever. Or
Well, this is I understand the question. Well, I think this is to some extent an individual choice and is tailored. I mean, each company may have a different approach, but the intention is keep in mind that, as Maximo was mentioning, phase 2 is there is no limitation, let's say, for the sector. As more business cases you have, the better, of course. Phase 1, the intention to have the focus that we give to 1 or 2 is not because you have to limit that, but to bring to your attention that you have to be concrete, have expression of interest of end users, and this may trigger your attention. If you focus with 1 or 2, you can bring in this to give value, to give substance to what you're submitting. Then to the question that you're asking about, should one technical roadmap for each sector, or I don't know. I don't think there is a definite answer to that. I think it depends on the sector. I think it depends on the business case. This is up to you to cover to cover this. But yes, I think as main element is of signaling these individual sectors is because of the expression of interest, and to give you a signal that you may be very concrete with this view. And then if you have other sectors in which you can also touch upon in your activities, the better, because this will be, analyzed for sure during the due diligence and give you more value and more chances to enter to phase 2.
Okay, thank you.
Okay, then there's Antje.
Thank you so much. I have a question about the startup terms. So you talk a lot about the maturity of the product, but do you have any specific criteria about how late stage a startup could be, or potentially also if a spin-off process could be part of phase 1?
The question is the late stage of a startup, the latest stage of a startup. Well, I don't know. I don't think there is a particular limit for phase 1, but René, maybe you can further develop after and provide elements here. But for phase 2, Maximum gave already some elements. There is a clear venture debt product that is targeted to well, I don't want to make mistakes. Scale ups, is that the correct before this?
More mature startups, let's say. Not pre-Series A. For the phase 2, companies or startups that are still at a business angel, seed, pre-seed stage, they will not qualify because I guess they will not have the capital and the human resources to execute the amounts of financing that we will be given, because the amounts of financing will be to a project. So at least for phase 2, there are clear, let's say, limitations. It cannot be a recent spin-off from a university because they will not have the capacity. If they prove that they have capacity and they are still young, great, we can see that. But in principle, we would expect companies that are relatively more mature, at least for phase 2. For phase 1, I think Christian mentioned that I don't think there's a limit, but it's upon colleagues to confirm. But I think that phase 2 is clear. I think I have expressed it.
Yes, so it is indeed correct for phase 1. We have not set a lower limit for it, but bear in mind it's a competitive process, right? So you have to convince a panel of experts, and you're competing potentially with more matured companies, and they can make a better case for themselves.
Thank you.
Okay, then there's Rodrigo.
First of all, thank you for your attention and your time. My question is, you mentioned that there's a possibility that the activities of phase 1, the grant activities might overlap with the activities of phase 2. So I was thinking about this and what would be an indicative duration of this time. And for example, if considering the interval between the submission of phase 1 and the submission of phase 2, let's say that we don't have all of the deliverables done, that we have an overlap, that we have a roadmap with a duration of 5 months or 6 months. how does that impact in terms of the outcomes of phase 1 for the submission of phase 2? Thank you.
Do you want me to take it, René? Okay, the overlap that from phase 1 to phase 2 that was mentioned before was more in terms of content. Let's say we are expecting that the financial roadmap and the technical roadmap that is developed under phase 1 will nurture the due diligence, let's say, and stay for a certain time there. So also overlapping in phase 2. Not that when you enter in phase 2, you develop a completely new, let's say, business case and completely new roadmap, technical and financial. This was let's say, the intention. Now, your question on the timing. Well, this is a bit tricky because we can give you some, let's say, general timelines, but then I think it depends individually on a case-by-case basis, because as the due diligence is a process that is on a case-by-case, that will depend. But generally speaking, what happens is that the call is open now. It will be closed in January 2026. Then there will be some time for the evaluation and the panel of experts that René was mentioning. And typically, we have the obligation, well, it's not an obligation, it's a good practice to remain within 8 months time to grant, so from January, but it depends how many applications we will have. But I think that within 5-6 months, we can finish. This René can confirm. So from January, we get until, let's say, June 2026. And by September 2026, the expectation is that phase 1 can start. This is the idea. Then if you consider 3-4 months, we go end of phase 1 by, let's say, December 2026. There will be then a review, which is a standard process for any Horizon Europe funded project that can take place, for example, in January 2026. And already some elements of phase 1 can start. For example, the two processes that I was describing, which is the financial pre-screening and the big due diligence, they can be displaced. And this is the, let's say, the advantage of the approach that we have here is that we can anticipate the financial pre-screening earlier. This can be discussed, but typically already during the execution of phase 1, and then the full due diligence after the end of phase 1. So in this case, we are gaining well, overall time, because we are anticipating a process that is the financial pre-screening, and we are offering to the company the grant for compensation, for helping them, for developing the roadmap, etc., etc. So in other words, starting from January 2027 on, I expect that the EIB can already have a look at the due diligence process, and this will take the time that it will take. And so maybe Maximo, you can complement with this, with the timing of the due diligence. But I expect that is very much individual.
With the technical activities that are mentioned, because you're expected to have physical proof or a prototype or a proof of concept that you can document by the end of phase 1. Let's say that those technical activities are not completed. Can they stretch a little bit longer? Is there room for this?
It's a good question. In principle, what matters is the review. So at the review, you have a panel of experts that is analyzing the implementation of your action, and well, we have a first assessment. But then I don't know how much flexibility you have during the due diligence. if you enter the due diligence, let's say, with an unfinished technical element, how much? I guess it depends on. I mean, there is. I understand during phase 2 there is possibility of using R&D costs, but I guess that, and please Maximo confirm that you need to demonstrate a certain core activity to be able to enter into phase 2, and so I think it depends on a case-by-case basis. If you need, well, I don't know. I leave it to Maximo to reply.
Correct, Christian. So I will try to answer two things. First, in terms of the overlaps of activities, as Christian said, with that timeline, and if you recall the slide that we have shown about the so-called EIB project, which is the investments that we support, actually the overlap of activities might not be that big, because actually it might be that our project will be covering investments from 2027 onwards and not 2026. It will depend. So that's on one side. The overlap, financially speaking, at least for us, we don't believe that it will be that large given the timelines. That's the first answer that I wanted to give for phase 2. And then with respect to the actual execution of the technical components, for the phase 2, we will need to see, as I mentioned, companies that when we do diligence them, they have a certain minimum criteria to be bankable and commercial stable, and that they will have the capacity to digest debt, and that they will have a clear strategy for growth. So we would like to see companies that are proving that the product that they have is already commercially available. So if there are any delays, and by the time that we look at the company, the commercialization will be too much delayed, then it will be very difficult for us at the diligence stage to say, okay, yeah, we will invest. I mean, we will do our own assessment of the companies, and the companies need to have certain minimum criteria, like not only like we do in quantum, but like in any other sector. So we will apply the same criteria. There are certain minimum standards that for a company to apply for us, they will need to meet at that stage.
All right. Thank you so very much.
Okay, then maybe this could be the last question. Amado, please.
Hi, Christian, and everyone. Thank you again for the information. So I have actually two questions. Maybe the one is very short. And so what or how a fully bootstrapped company can fit into this program? But this bootstrapped companies has the capability of a equivalent Series A company today. Will it still be possible to apply for this grant? This is one question, and if the second is more like a common question, if I understand correctly from the timeline, it will mean that the funding could start mid of 2027. Is that correct? At the earliest, because the due diligence starts beginning of 2027, right? So we should count for this grant to be up and running by mid of 2027. That are just my two questions.
Should I take one part of it, René? For the grant, well, there are two. So phase 1 is a grant, and phase 2 is a loan with the EIB. So for phase 1, no. The answer is it will start in 2026. That's the expectation. Phase 1. As we were mentioning before, there is no real limitation in terms of companies to enter into phase 1. So your example, I expect it to be okay. So because it's, I mean, if we don't have limitation in terms of startups or SME, this is not really an issue for phase 1. But then we need to complement with phase 2. I don't know what is a bootstrapped company. which is equivalent of Series A. Yeah, thanks a lot.
Happy to jump in, Christian. Hi, Amado. Nice to meet you. And bootstrap companies, in principle, are not discarded if the capital strengths of the company are such that they can still digest debt. I mean, and also if when we assess them, they have an appropriate governance, an appropriate strategy, and an appropriate team. So normally why we put the condition of the Series A, Series B is because normally that means that the companies will have capital enough to execute the investment plan, because as mentioned, the investment plan that needs to be executed, the so-called EIB project, is double the amount that we will put. So by definition, a company will need to have capacity to digest that via having capital. Obviously, if you're a bootstrap company that doesn't have that much need of capital, but you have generated revenues and you are very sustainable, if you can digest the transaction, if you can digest debt, then we are happy to explore. But at the same time, we will need to see whether if your technical, economical, and your governance standards are well enough placed for us supporting you and for believing that, okay, the company makes sense, we can invest there, and we are aligned with, in this case, not with other investors, but also with the management team of the company, which are the investors in the company. So it will not be discarded, but it will have to be taken care of in a different manner. I don't know if that answered the question, Amado. And in terms of the timing, for us, of course, it will depend a bit on how ready the companies are to provide the due diligence package. But we would expect to be working already on the due diligence during this year, mid this year. So when the financing will be given, to be seen, but we would expect that at least during 2027, our EIB loans for the companies that are selected and successfully eligible should be available for them. That's a bit it. I hope I answered your questions, Amado.
Yes, thank you so much.
Okay, I can see no further questions. 2 items for housekeeping. So the slides, we will do our very best to provide them as quickly as possible, hopefully today. And then all the additional questions raised, we try to compile them in the Q&A document as well, so that everybody has access to the questions asked and also to the answers provided. And with that, I would really like to thank Massimo, Desiree, Tobias, and also Christian for taking time. And then with this, we would like to close and wish you all a good Friday afternoon and hope to see you soon.
Thank you very much.
Have a good weekend. Thank you very much, everyone.
Thank you.
Thank you. Bye.
Thank you. Thank you.
Thank you. Bye-bye.